Good evening, guys. I'm making this video after a long time, but we'll try to be more punctual, more regular with this. This is a very simple understanding of what bond yields are. How do they affect the equities market? How do they affect the currency market, fluctuations? And what are the implications on potential returns on investments, current investments as well as previous investments? So now let us look at globally, financial markets are basically divided into three categories. Basically, two categories, but we will discuss three categories. One is equities, which is the smallest part. Another is the bond market, which is the biggest part. The, globally, bond market is more than 10 times the size of equity markets. In between comes the currency markets. So basically, there are three ladders. First is bond market, second or debt market, second is currency, and at last comes equities. But since equities move a lot and retail investors, they have a lot of say in direct equities. The participation of retail investors in direct equities is much more as compared to bond market or currency markets. Hence, the news coverage or the emotions flowing out of fluctuations in equity markets are much higher. So now let us understand why the bond yields globally is rising. What is the reason behind it, and what will be the implications? To give you a perspective, in March 2020, when Corona came in, inflation in the United States was 1.6%. The target for US Fed Reserve, the equivalent of Reserve Bank of India, the Central Bank of United States, the target inflation was 2%. They wanted inflation to move between 1.6 to 2%, which will give them stable interest rates, and the economy will do reasonably well. It was supposed to be a smooth ride. But what happened after Corona? When Corona came in, the central banks, they started giving money to the people. On behalf of the government, the central banks globally across all countries, whether it is Pakistan, India, Japan, Brazil, United States, Europe, China, every country started giving money just to support them, support humanity. But with this, how do they give money? They cannot print money and give it to them. Na? So what they did was they started buying bonds. They started buying bonds, and in return they make a payment. That payment used to go to these to the people of the country. But when the economy started opening, there was a huge increase in commodity prices, a sharp increase in commodities prices. And if I remember correctly, it started with iron ore prices. Iron ore, lead, copper, cotton, coffee, tea, everything started moving. And currently, all the prices are nearly the double of their prices in the last one and a half years. So what happens is when you have a sudden rise in prices, a sudden spurt in prices in raw materials, your cost of production goes down. Sorry, your cost of production goes up and your margins come down. When margins start coming down, then it creates a profitable pressure on the companies. So, but why are bond yields rising, and what is the reason behind bond yields and uh, commodity prices going up? So let us study that. Earlier, we had a low interest rate scenario. For the last 20-25 years, we have we are seeing low interest rate scenario. When I started working in the year 1999 2000, FD rates were close to 13-14%. My colleagues in banks used to sell escorts FDs at 13.5%, 12.5%. Now you have FDs at a return of 5.5%. So we have a lower interest rate trajectory for the last 20-25 years. But now that is about to change. Why it is about to change? Let us see. What, before that, we understand what is interest rates. When the interest rates are lower, we get a lower returns on fixed deposits or debt instruments. Higher interest rate means you get higher returns. The problem is the sudden change. Why? Because it disturbs the flow of money in the market. And that flow of money, that disturbance is locally as well as globally. But why it happens? It happens because there is a change in inflation or the price. What is inflation? Inflation is a relative rise in price when compared to a previous time period. So higher inflation is equal to higher price, which in turn means a lower savings for a household or a family. When you save lower, then you spend lower because you got to do something for your future also, because you are earning lower, so your spending is also lower. So lower inflation is equal to stable prices, not lower prices, or stable or a small rise in price is equal to higher savings, and that comes to higher spending. Higher spending means for important things as well as discretionary things, like some things which are very important like food, oil, school fees, everything. Discretionary spending like holiday, cars, or a wedding expenditure, that is discretionary spending. So let us take the example of USA, which is a very live example. So normal increase in salary in United States is around 1.5 to 2%. To give you a perspective, 91% of the population in United States is a working class population, and the similar number in India is only 22%. So a 22% of percentage population in India is salaried population. That is the white economy, not the black economy part. But in United States, that number is close to 91%. In Europe, that is also 80% or higher. In Japan, it is also more than 80%. So a normal price rise in United States is 2%, but the current rate of inflation is 8.5%. So even after an increase in salary of 2% for a top performer, you end up at minus 6.5% for the year. That is, you probably lost 3 years. 3 years of earning you have already lost in 1 year. So basically, it is 3 plus 1 is equal to 4 years you have already lost. So in case if the inflation currently stands at the same situation is end of March 2023. Today is 2022, April 2022. So if the same situation happens in March 2023, 1 year down the line, then you have lost close to 6 to 7 years of earnings. 6 to 7 years of earnings means you are going back a lot. आप काफी पीछे चले जाते हैं लाइफ में, in terms of your living standard, in terms of your loans, everything. So a person earning 70,000 rupees in India has a 10% price salary increment, goes up till 1 lakh rupees, but suddenly a year sees the kind of inflation is happening and he comes back to 70,000. So a person, a human will spend money as per his expenditure or as per his income. But when your income starts shrinking, then you have a problem. Now, what is the problem? Interest rates and inflation. So higher inflation is equal to what will happen is central banks will increase interest rates. When rates go up, then the cost of capital will go up because banks will lend at a higher cost. When your cost of capital goes up, then your returns come lower. When your returns are lower, then you automatically carry a higher risk on investments. Then you automatically carry a higher risk on investments. When you have a higher risk on investments, then you have low capital allocation. Then your capital allocation in riskier investment goes less, and your capital allocation is risk free, that is debt markets or bond markets goes up. When the investment in bond markets start going up, then it creates a higher bond yield scenario. And in higher bond yields, the currency starts coming down. The currency value goes down. Yields basically is returns. So this creates a shift in capital from risk to risk free, which creates pressure on equities. So under those circumstances, what will happen is this is what will happen. Stable currency is the best for any country. So higher bond yield is equal to lower currency value, equal to higher import cost, because when you have to pay more for oil or more for anything which you import, equal when you pay more, your financial condition goes down, which is equal to poor fiscal deficit. When you have a poor fiscal deficit and your financial condition is poor, then you will get a loan at a higher cost globally. So if India wants to have a loan from IMF or World Bank, then it will have to pay a higher rate of interest. What will happen is, if you take a loan at higher rate of interest, then you have more interest outflow, क्योंकि आपको ज़्यादा पैसे देने पड़ेंगे in interest. When you are spending more, when you are paying out more, then you have much less left for you. When you have less left for you, then you have a lower government spending. When your spending goes down, when your spending goes down means when your investment goes down, then your returns also goes down. So when your returns comes down, then it shows in your lower GDP numbers. It will show in your lower GDP numbers. When your GDP comes down, you have low capital, wealth creation, foreign FDI outflow will become a inflow will become a problem. The stock markets will go down because of lower GDP. So you are losing capital as well as wealth. You are losing capital as well as wealth, which will result in lower corporate income, which then again it will, आपकी कंपनी नहीं कमाएगी तो आपको सैलरी भी इंक्रीमेंट भी उतना नहीं मिलेगा. So this is how this cycle goes. This is how the entire cycle of higher interest rates and lower interest rate goes. So now what is happening is, initially the US Fed said they will increase rates by 2 times or 3 times in a year. Now, with sudden rise in inflation, their expectation of inflation was around 5.5-6%, on a much higher side. But now it is at 8.5%, which has beaten all their expectations. So under this scenario, now it is said that in May, the next meeting in Fed, the rise in interest rates could be 0.5 to 0.75, which has never ever happened in the last 30 years. In the last 30 years, a 0.5 or 0.75% increase at one time in interest rates in United States has never ever happened. Because why? And it is important for them to do so. Simply because they have to bring inflation down, because they cannot work on an interest rate of 8%. Because why would a person in United States put in an FD at 2% when the inflation is at 8.5%? आप FD क्यों करते हैं? आप FD तब करेंगे जब आपका FD पे रिटर्न जो होगा वो इन्फ्लेशन से ज्यादा होगा, जिससे कि आपका नेट में वेल्थ क्रिएशन हो. बट यहाँ पे तो निगेटिव है, and that is negative by number of years, not by couple of months or couple of weeks. It is negative by number of years, three years. In the previous slide I showed. So under that situation, there would be a shift in money from riskier assets like equities to safer assets like bonds or government bonds which have sovereign rating. मतलब देश ने आपके बॉन्ड को गारंटी दी है. इट इज अ कंट्री रेटिंग, दैट इज सॉवरेन रेटिंग, दैट इज द हाईएस्ट security rating a bond can have. So the money starts moving, and that is precisely the reason why since October last year in Indian equities, FIIs have pulled out close to 3 lakh crores of money from Indian equities. That number is not that high in bonds, but it is much higher in equities. This is the biggest reason. It is not about returns, it is not about quarterly results or anything. Why? 20 years before, the valuation of markets was much less as compared to today. Why? Because it is all about free money. Since the Lehman crisis of 2008, banks are lending, giving free money. So the valuation has already gone up. So this is how the bond markets work. So bond markets has to stabilize, has to come down slowly for our equity markets to stabilize. Thank you guys. Thank you so much for listening.